Hi everyone, this is Mrs. V. Chen. Welcome to my Form 5 Accounting Lesson 7, and today is 29th February 2020. Okay, so let's do another DSE question on admission of a new partner. Okay, all right, so this is the question here. So at the beginning you have Jay and Joe, right? And after that you have Tom here, okay, admitted into the firm. All right, and there are two parts in this question. The first part, you have to prepare capital accounts, okay, to show all the transactions related to admission and the adjustments related to admission of the new partner, and who is Tom, okay. And then later on, part B here, you have to prepare appropriation account for the new partnership. Are you okay? Now, something very, very important. Now, here is the timeline. Okay, so timeline here, we have Jay and Joe being the old partners, and on the date here, 1st of January 2017, so Tom admitted. All right, so, and then remember for admission, we always have three things to do here, so which is the capital introduced by Tom, and then we need to do goodwill adjustments as before, and then we need to reevaluate the value of assets. Okay, and then 1 year later here, which is part B, that we have to draw up the profit and loss appropriation accounts. All right, okay, now I have my capital accounts here with three columns here, and at the beginning Tom was not yet here, so I only have two opening balances, and one for Jay and one for Joe. I get this from the first paragraph here. Okay, and then now we come to point number one. Point number one, we are given the new ratio, profit and loss ratio, and be very careful about this part. Okay, Tom will be paid a monthly salary by check. Now be very careful, because even though this information is in part A, however, part A saying that we draw up capital account for admission. Remember, whenever we have admission, we only have three things to do. So these three things always: admission, capital introduced, goodwill adjustments, and revaluation of assets. So therefore, even though we have this point one mentioned here, actually this part should be no effects in the capital account, right? So therefore, at this moment, we ignore this point. Okay, now we come to the usual adjustments. Here we have goodwill was to be valued at 80,000. Okay, and the new partnership would not keep a goodwill account again. This is method 2. Method 2 is better, saying that goodwill not opened. So we do another practice. Okay, so therefore we need the table here. Okay, to do goodwill adjustments. Okay, so goodwill given 80,000. This is 80,000. Okay, by using old ratio, Tom it's not here yet, so I use calculator to share that. So that would be 80,000 divided by 5 times 3. So that is 48, goes to J, and then minus 80,000. Okay, so the remaining goes to Joe. Okay, so if we change ratio to this new ratio and share by 3 of them, so 80,000 divided by 10 times 3, so that is 24,000, and this is also 24,000. Okay, so the remaining 24,000 times 2 and minus 80,000. Okay, so that is 32,000. Yeah, right? So this part is exactly same as before. Okay, now we come to adjustment for who gained and who lost. So remember who established goodwill. It should be always the old partners. So that J should get 48. But right after changing the profit and loss ratio, J get a loss. So I give a bracket here. So J has a loss 48 minus 24. So that is 24,000. And Joe established goodwill, which is 32,000. However, right after changing profit and loss ratio, so Joe has a loss, so 32 minus 24, so that is 8,000. And Tom actually, okay, established nothing. Okay, so therefore, Tom get a gain here So you can see this gain loss actually, which is not fair to them, right? So therefore for the gain, we have to charge Tom. So debit capital for Tom by 32,000, right? And then we need to compensate J using capital, that is J 24,000, and compensate Joe as well, credit capital, and that is Joe, and that is 8,000. Okay, so done. So therefore this is goodwill adjustments using method 2. We don't open goodwill accounts, and then we use capital account for all the adjustments. Okay, now let me do the posting. So debit Tom here 32,000. Okay, so we always debit the gain and credit the loss. Reason is goodwill adjustments, and then I need to credit J and credit Joe here, and also because of goodwill adjustments. Okay, so next we come to revaluation of assets, and saying that here, so all other assets were to be revalued upwards. That means the original value is too small. Okay, and how do we increase the value of assets? We debit assets. Okay, by this much. Okay, and credit revaluation account 120,000. Now since we only have one transaction related to revaluation of assets, so to save time we can skip the revaluation account, so to make it faster to finish this question. All right, and then you look at this credit, and this is going up the assets, so you can see this is the good news. Is that right? All right, so I'm going to close revaluation account. So debit revaluation accounts by 120,000, and this is a good thing because of gain, so credit. Okay, capital. Now something important here, so who's going to share this gain of revaluation? Remember, it is always the old partner, so that will be J and Joe only, using the old ratio, so 3/5 and 2/5. Okay, so share this, so 120,000 divided by 5 times 3. Okay, so that would be 72,000, and the remaining, okay, 48,000. So you can see sometimes to work out gain or loss on revaluation, okay, we can skip the T account revaluation and do double entry to work out the same thing in order to save time. All right, now I do posting here. So credit capital, where is my capital account? My capital account is here. So only the old partners will share the gain or loss on revaluation. So 72,000, 48,000, nothing for Tom. Remember, always the old partner, and that is revaluation. Okay, so this is it. Okay, so next you have another tricky thing here. So now given you interest on drawings and given you interest on capital, all right, so since this is part A, even though you have this information in part A, actually in part A related to admission, and always remember we have 3 things for admission, so that is capital introduced, goodwill adjustments, and revaluation. So therefore point number 3 here, actually we have nothing and no effect at this moment. Okay, so we can just ignore point number 3. Okay, and then we'll come back point number 3 later. Okay. Okay, so next let's check what we have done so far related to admission of Tom. We have done goodwill adjustments, we have done revaluation of assets. Okay, now this capital introduced it. Okay, now we are going to solve this problem. And actually, point number 4, this point is the most special thing in this question, and saying that Tom had to bring in sufficient funds of capital, which is equivalent to 40% of the total capital. Okay, so and however, how much is total capital of the business, which is not given. So therefore, what can we do here? Okay, let's take a look on the capital account as well. Now so far we have nothing here for Tom. all right, because Tom has to bring in something which is capital introduced, and then we don't know how much is it, okay, and which is not given to us. And here is one transaction for Tom as well. Okay, so in that case, so let us close all the adjustment for J and for Joe first. Okay, so if you use your calculator, okay, so you can close J's account in this way, 325, and nothing here, 325. So therefore, so the closing balance for J will be 325,000. Okay, and then you use your calculator to close the column for Joe. This is 200,000, 200,000, nothing here. So therefore, this is 200,000. Okay, now we come to the most difficult thing. So according to the question here, okay, it says, so the percentage for Tom's capital should be 40%. So therefore, we have to fix something here to 40%. All right, so therefore, what about the remaining here? The remaining here will be 60%. Okay, so next we need to do some calculation, some mathematics. Now, total capital is not given to us, but we know that the two of them actually, for J and for Joe, consist of 60% of the share of total capital. So TC is my total capital. So to work out TC, I have to plus these two and then divide it by 60. So 325,000, sorry, so 325,000 plus 200,000 divided by 0.6 to get total capital 875,000. Okay, almost done. If this is total capital, therefore here 40%, so times 0.4, so this will be 350,000 will be the share of Tom. Okay, so finally I have 32 here, so that I can close the T account in this way, plus 32,000. So this is the total column, 382,000. Okay, so here is also what's 382,000. Okay, so finally we can solve. This is the amounts that need to be introduced by Tom in this question. So that would be 382,000. Okay, so therefore in this question, point number 4 is the most special point here. And also to remind you one more time, okay, so this salary paid to partner, okay, and interest on capital, interest on drawings actually has no effects on the capital accounts. All right, so to remember this, you just look at the timeline here. Okay, for emission, always remember we have 3 things to do: capital introduced, goodwill adjustments, and revaluation of assets. And for capital introduced, this is a very special point, and we need to do some mathematics and calculation here. Okay, so next we come to part B, which is to prepare the profit and loss appropriation accounts. So remember, in the previous lesson, we have this partnership, the income statement. We have the extra part, which is called profit and loss appropriation account. Now let's take a look. What do we have in the profit and loss appropriation account here? So we add interest on drawings because that means the partner has to pay and the firm receive. Okay. All right, and then the firm has to pay salary to Tom. Okay, and there is interest on capital. Okay, so since in part A, we have already worked out capital here, remember, just now? So these 3 figures will be capital balance here, 325,000, and then 200,000 for Joe, and then 350 for Tom. And the percentage is 4% if you refer to the question here, 4%, right? Okay, and let me use calculator. So 325 times 0.04. So that is, okay, I put it here, 13,000. Okay, so 200 times 0.04. So that is 8,000 and 350 times 0.04, oops, so that will 35,000 times 0.04, okay, which is 14,000, right? Okay, all right, and now we have salary to Tom. Okay, you need to go back to point number 1. Okay, saying that Tom would be paid a salary 22,000. Since Tom is one of the partners, so the salary to the partner should go to profit and loss appropriation account. So 22,000. So here 22,000. But be very careful. This is monthly, so for 1 month, and the profit and loss account is last for a year, so times 12. Okay, so don't make any careless mistake here. 22,000 times 12. Okay, so that would be 264,000. Okay, so after we have finished all the straightforward things in the profit and loss appropriation account, like salary to Tom and interest on capital, okay, now we go back to a difficult one. So what do we start with in the profit and loss appropriation account? We start with net profits. However, in this question, net profit is not given to us directly. We need to show workings to work out net profits, okay? And here is my working. So this is my working to find net profits. Okay, so we start with sales. This is sales. Sales is here, right? And then less cost of goods sold. Okay, no special thing here, and then gross profit. But however, when we come to operating expenses here, okay, so the operating expenses include salary paid to Tom. Now the point is, this is the profit and loss account, and operating expenses we should not include. Okay, so this is salary to Tom. So why? Because salary to Tom should go to appropriation account instead of profit and loss account, so that we need to do adjustment and take away this. All right, remember this is monthly salary, so times 12 for a year. Okay, all right, and then here there is another adjustments, so which is interest expense. However, also include interest on capital. Remember where to go for interest on capital, not in the profit and loss. However, it should go to the appropriation account. So I start with 75,600 here. So 75,600 here to minus all interests on capital. So here is the appropriation account. So interest on capital altogether 35,000. So I have to minus 35,000 because interest on capital should go to appropriation account instead of the profit and loss account. Now I can close this. Okay, finally, so 75,600 minus 35,000, so this is 40,600. Okay, let's check what is the net profit by using calculator. So 2917 minus 2,148,000 minus 4,600, so that is 728,600. Okay, all right, so therefore I go back to this net profit in the appropriation account. This is 728,600. Okay, so now finally in the profit and loss appropriation account, we have one more thing left, which is interest on drawings. Again, to remind you one more time, timeline is very, very, very important. If you ignore the time, then your calculation will be all wrong. So here is the timeline for drawings out here. Okay, at the beginning and then at the end, and the dates withdrawn on 1st May for J. So here from 1st of May up to the end, okay, which is 8 months. This is very, very important. Okay, now here is another timeline at the beginning and then at the end, and the dates for drawing is on 1st of July. So you can see how many months we only charge 6 months interest. So this is very, very important. Okay, now go back to calculation. Interest on drawings, add to net profit. So the date is 8th, 12th, and then 6th, 12th. Again, to remind you, very, very, very important. If you ignore the dates, all your calculation will be wrong. Okay, so here I can do calculation times 8 divided by 12, so 6,000. Okay, match the place. For J is 6,000, and then for Joe 0.5 times 6 divided by 12, so 3,000. Okay, so add them all up, so 7,600, and minus how many things do I have here? I have salary, and then I have total interest on capital, so 229. Okay, almost done. Let me check. So this is minus, so 7,600. Oops, it's not the same. Okay, so just now I made careless mistake here because the total for this 264 salary 1,000 and interest on capital should be 299 instead of 229. See, I made careless mistake. Okay, so therefore my calculation now is correct. So 737,600 minus this 299 is same as the profit here. Okay, so since this is positive, therefore we have share of profits, and 3 of them are the new partners. Okay, so 438.6 divided by 10 times 3, so J should get 131,580, 131,580, and then times 2, and the remaining 438,600. Okay, so this is how we close the appropriation accounts. If we have positive figure, okay, therefore we have share of profits. Okay, so what is important here? The dates for interest on drawings is important, and these two are straightforward. And then you get this from where? You get interest on capital from part A, which is the closing balance in the capital accounts. Okay, now we come to the final C, part C here. Briefly explain whether the balance of Tom's current account would include the annual salary he was entitled to. Okay, so let's look at this salary paid to Tom. All right, so salary to partner should be always in the appropriation account. All right, and you look at point number 1 here, saying Tom would be paid a monthly salary, so that means the firm already pays salary to Tom. Therefore, do we need to credit current account? The answer here for C is a no. All right. Okay, so here is the answer. So as Tom's salary has been paid at the end of each month, so there is no need to pay, no outstanding salary owing to him. So it will not be included in the balance of his current account. Okay, so that's all about this question. Admission of a new partner, and a year later you do profit and loss appropriation accounts. Very good. So thank you for watching my video, and see you next time. Bye bye.